In today's day and age, there are a million and one ways to create another stream of income for yourself, like drop shipping. You can start a YouTube channel or try your hand at one of the countless side hustles you hear people talking about. But for most people, none of these things are feasible. Most people are looking for something more passive that won't end up just turning into another full-time job. And for that, if you're looking for passive income, the easiest way to go about it is going to be investing, and specifically investing for cash flow. Now, when most people think of investing for cash flow, they think of investing in real estate and buying rental properties, which obviously is a tried and true way to go about it, but it's not the only way. The other way to invest for cash flow, and the way that I'm personally more partial to, is dividend stock investing. And when most people think of investing in stocks, they think of buying these things that just go up and down, sometimes without any rhyme or reason. But what a lot of people don't understand is that one share of a stock is actually a little sliver of a real life business. And when you buy shares of a stock, you're actually technically now an owner of that business. But anyway, some of these businesses like Coca-Cola, Starbucks, or Home Depot, just to name a few, will pay you a dividend every single quarter, which at a very basic level is a portion of the company's earnings that they give to you just for being a shareholder. And this is what that looks like. So here you are, okay? You are looking to create some cash flow, and you've got your mind on your money and your money on your mind. But anyway, you've decided that you are going to start investing in some dividend stocks, okay? You start putting some money into there from your paycheck, and then sometime in the next quarter, you get your very first dividend, and you can use that dividend for whatever. You can use it to pay bills, set it aside for vacation, take yourself to In-N-Out Burger, whatever you want to do, which in theory sounds like a pretty sweet deal, but there is a catch. Imagine that in this example, you are investing in something like Coca-Cola, which I think is a pretty great place to start. I mean, by no means is it a bad choice. Over the years, Coca-Cola's been one of the most reliable dividend payers out there. And the company's been growing its dividend for 60 straight years, which is twice as long as I've been alive, by the way. But at any rate, maybe you started your portfolio here with $300, and seeing as Coca-Cola's current share price is about $60 per share, you can pick up 5 shares right off the bat, which is a great start. But here's the catch. Coca-Cola only pays 46 cents per share per quarter. So when your first dividend payment comes in, your 5 shares are only going to be paying you $2.30, which, like, what are you going to do with that? And that's the double-edged sword of dividend investing. When you first start out, you're not going to be making a whole lot of money. But on the bright side, this is still $2.30 that you didn't have to lift a finger for. You are on your way to building wealth and reaching financial freedom. And with that $2.30, if you were to reinvest it and go buy more shares of Coca-Cola, then something pretty magical starts to happen. And this is where dividend investing can become a pretty powerful thing. So once again, if you reinvest those dividends to go back and buy more shares, then the next time you get a dividend payment, the dividend payment's going to be even larger, which once again, if you then use that money to go and buy even more shares, then the third time around, your dividend payment will be even larger than the first two. And now you've got yourself a sort of flywheel that builds upon itself. And if you just keep doing this over and over for months and years and decades, eventually it will take on a life of its own. And that's where the real wealth is built. And that's how you reach financial freedom. And this is why I love dividend investing. Yes, it starts off pretty slow, but with each reinvestment, that dividend snowball gets bigger and bigger. And eventually it gets to a point where it becomes this like unstoppable force. But like I said, guys, this doesn't come easy. Unless you're starting off with a really large sum of money, building passive income with dividends is a process that usually takes decades. But fortunately, using this market beat dividend calculator, we can see what a portfolio might look like, 20, 25, 30 years down the road if we started investing in it today. And in our portfolio, guys, we are starting with that $300 we mentioned earlier, and every single week we'll be contributing $100 into this portfolio, which has a 3.5% starting yield, a dividend growth rate of 8%, and a share price growth rate of 8% as well. And we're going to forecast this over the next 25 years to see what it looks like after that. And with that, after 25 years, your $300 and your $100 invested every week turns into over $600,000. And by the end of that 25th year, you are generating about $21,300 of annual dividend income, which amounts to almost $1,800 every single month. Now, just for fun, if you were to double up your contributions and instead of $100 a week decided to invest $200 per week, your ending balance basically doubles, going from $600,000 to just under $1.2 million, and your annual dividend income does the same, going from just over $21,000 to $42,400, which is roughly $3,500 every single month. So over time, things can get pretty crazy, and you might be looking at those numbers thinking, well, if a 3% yield can get me those sort of results, what happens if I invested in something with a 6% yield, or better better yet, a 9% yield. And I understand the thought process. You're thinking that something with twice the yield should double the results. And while it's true with the same amount of dollars invested, you will make more with a 6% starting yield than you would with a 3% starting yield. And as tempting as it is to just buy something with the highest yield possible, that is a very dangerous game to play and not the best way to invest, especially if you are a beginner who's just starting out. While there are certainly exceptions to this, high yield stocks are generally considered to come with more risk, and as a shareholder, you're compensated more for that higher level of risk, hence the higher yield. And so with that said, it begs the question, okay, well, if I'm supposed to be staying away from these high yield stocks, then how do I know which dividend stocks or which companies? Because remember, stocks are just slivers of actual real life businesses. But anyway, how do I know which ones are going to be the good ones to invest in? Well, you have to do the research. You have to learn about the company. You have to understand how they make their money, and you have to know if they have strong enough financials that will allow them to continue paying you a dividend. And you might be thinking, whoa, I don't want to do any of that stuff. I don't want to have to research companies and go look at financials. I don't know how to do any of that stuff. And frankly, I'm not interested in learning. And honestly, that's okay. You don't have to. Instead of buying individual companies, you can just buy an ETF or an exchange traded fund, which essentially is just a big basket of different stocks all bundled into one fund that you don't have to manage yourself. ETFs are a pretty hands-off way to invest and are a great place to start if you're just getting into investing. And in this next video right over here, I'm ranking the top 10 dividend ETFs from best to worst. In the video, we'll be reviewing 10 of the most popular ETFs to see which ones would be good additions to your portfolio and also which ones you should just forget about. So click right over here to check that out, and I'll see you in the next one.